Friends, thank you for being here today. We stand at a precipice in our nation's financial history, a moment that historians will look back upon as the turning point where the old rules ceased to apply and a new, harsher, yet more honest reality began to take hold. We are not here to discuss mere market fluctuations or the daily noise of the stock ticker. We are here to discuss the fundamental solvency of the institutions that hold the deed to the global economy. What if I told you that the very banks entrusted with the world's wealth, the institutions deemed too big to fail, just admitted, in the dead of night, while the world was distracted by holiday festivities, that they are technically insolvent? And how would you react if you knew that the money in your pocket is being actively devalued at an accelerating rate specifically to save these reckless gamblers from a bet they can no longer cover? These are not hypothetical questions. They are the reality of the post-Christmas financial landscape. While families were unwrapping gifts and enjoying leftovers on the morning of Friday, December 26th, a seismic event occurred in the plumbing of the financial system. It was an event so significant, yet so quiet, that it signals the end of the paper game we have been forced to play for the last 50 years. This brings us to the smoking gun, a Friday morning confession from the Fed. For years, many of us who value common sense over Wall Street rhetoric have suspected that the game was rigged. We looked at the charts, we looked at the mounting debt, and we hypothesized that the bullion banks, the massive financial houses that trade gold and silver, were playing a dangerous game. We believed they were leveraging themselves to the hilt, selling paper contracts for metal they did not own, effectively practicing fractional reserve banking with commodities that are running out. But for a long time, that was just a theory. It was a mathematical probability, sure, but we lacked the smoking gun. We didn't have the body. Well, stop guessing, stop speculating, because that day is today. The body has been found. While the mainstream media was likely distracting you with celebrity gossip or political theater, and while investors were marveling at the spot price of silver hitting $77.16, something much darker and more terrifying was happening in the deepest recesses of the banking world. We received official data from the Federal Reserve Bank of New York regarding their overnight reverse repurchase agreements, commonly known as the repo market. The number that flashed across the terminal was not a typo. It was a confession. $17 billion, $251 million. In a single morning, in the quiet hours just after Christmas, the giants of the banking world tapped the Federal Reserve's emergency liquidity window for over $17 billion in cash. To understand the gravity of this, you must understand what the repo market actually is. It is often wrapped in complex terminology to keep the average person from looking too closely, but the concept is simple. The repo facility is the pawn shop of last resort. It is the emergency room for a financial heart attack. If you are a healthy bank with a balanced book, running a sound business, you do not touch the Fed's repo window. You trade in the interbank market. You borrow from your peers because they trust you. Avoiding the Fed's window is a badge of honor. Going there is the walk of shame. It signals weakness. It signals that no other bank is willing to lend to you. So, we must ask ourselves, why would the masters of the universe, the entities that supposedly control the global economy, need $17 billion in cash at 8:00 a.m. on the day after Christmas? Was it for payroll? No. Was it for operational expenses? Certainly not. They needed it because they are bleeding to death. They needed it because they just received the biggest margin call in the history of the commodities markets. This $17 billion is not a stimulus check. It is a tourniquet. It is a desperate flailing attempt to stop the patient from dying on the table before the public realizes how sick the system truly is. And look at the timing. In the banking world, bad news is always buried on a Friday. Banks fail on Fridays. Regulators seize assets on Fridays. The fact that this massive liquidity spike happened on the Friday after Christmas, when trading volume is thin and nobody is supposed to be watching, tells you everything you need to know about the severity of the crisis. They were hoping this would slip under the radar. They were hoping we wouldn't notice the Fed printing billions to bail out a silver short. But we noticed. We are watching. And what we are seeing is the breakdown of the suppression machine. To understand why this bailout is happening now, we have to look at the trigger, the silver short squeeze. For decades, the scheme worked like a well-oiled machine. The banks would sell paper silver, contracts promising to deliver silver in the future, to push the price down. If the price rose, they would simply sell more paper. Since they have an infinite supply of digital contracts, they could always overwhelm the buyers. They could always tamp the price down, trigger the stop-loss orders of retail investors, scare you out of your position, and then buy it back cheaper. But the one thing that kills that scheme is a liquidity crisis. If you run out of cash to post margin for your new shorts, you cannot sell anymore, you lose your ammunition. Yesterday, silver didn't just go up, it gapped up. It teleported to over 77,700. The banks are sitting on short positions that number in the hundreds of millions of ounces. They sold those contracts at 30. They sold them at $50. They sold them at 70, arrogantly thinking they could spook the market again. But But this time, the retail investors didn't sell. The Chinese industrial buyers didn't sell. The vaults were empty. The price went vertical. Do the math with me. Every single dollar that silver rises creates billions of dollars in losses on the bank's books. But there is a crucial difference between unrealized losses and a margin call. For months, the banks have been hiding these losses. They mark them as unrealized. They pretend that the price will come back down eventually, so they don't have to acknowledge the hole in their balance sheet. They kick the can down the road. But the Comex clearinghouse, the entity that guarantees the trades, doesn't care about accounting tricks. The exchange doesn't care if the bank CEO thinks the price will go down next week. The exchange cares about solvency right now. When the price moves $5 against you in 24 hours, the clearinghouse computer spits out a number. It says, "You are underwater. Post the cash to cover the risk immediately, or we liquidate your position." This morning, the computer spat out a number, and that number was evidently $17 billion. The clearinghouse called the banks and said, "Pay up." And the banks looked at their ledgers, looked at their liquid cash reserves, and realized the terrifying truth. They didn't have it. They are illiquid. On a mark-to-market basis, they are insolvent. So they had no choice. They gathered up their U.S. Treasury bonds, the only pristine collateral they have left, and they ran to the Federal Reserve. They pawned their treasuries for overnight cash just to keep the lights on. They did this to prevent the clearinghouse from forcibly closing their short positions. Because if the clearinghouse were forced to close those positions, they would have to buy back the silver at any price, sending the metal to $200 instantly. This represents the bottom of the barrel. It represents the moment where the banks ran out of their own money and had to start using the taxpayers' money, via the Fed, to fight the market. We have moved past the point of a mere financial crisis. We are now facing a physical crisis of paper promises versus real metal. The $17 billion buys the bank's time. It buys them another day, but it doesn't solve the problem because the problem isn't just a lack of cash. The Fed can print cash. They can print $17 trillion if they want to. The problem is the metal. The clearinghouse demands cash for margin, but the contract holder, the person on the other side of the trade who bought that silver contract, they don't want cash anymore. They have seen the inflation at the grocery store. They have seen the news from global markets. They don't want a settlement check that is losing value by the second. They want the metal. And this is where the math of insolvency turns into the physics of impossibility. Because while the Fed can wire $17 billion in a nanosecond, they cannot print a silver bar. They cannot digitally create an industrial commodity. The numbers coming out of the Comex delivery report are staggering. Usually, December is a quiet month for deliveries. Traders usually roll their contracts to March or settle for cash. But this December is different. This December is a run on the bank. We are seeing a total of 12,007 delivery notices issued for the month. To a layman, that might sound like just a random number, but let me translate that for you. One contract represents 5,000 ounces of silver. That means over 63 million ounces of physical metal are currently standing for delivery in New York. Let that sink in. That is roughly 8% of the entire annual global mining supply demanded in a single month from a single exchange during a holiday week. In a normal market, this number is a fraction of that size. Usually, hedge funds trade paper for profit, not for metal. But the behavior has shifted. The longs, the buyers, are not rolling over. They are holding the contract to expiration and demanding the warrant. This is the industrial panic we have warned about for years. The entities behind these contracts are supply chain managers, battery manufacturers, and sovereign wealth funds. They look at the mining deficits. They look at the geopolitical instability, and they say, "I don't want your cash. Your cash is melting. I want the metal." And here's where the panic sets in for the banks. They don't have it. If you look at the registered category in the Comex, vaults, the metal that is actually available to be delivered against these contracts, it has been bleeding dry. We have tracked the drain for months. The registered inventory is hovering near historic lows. So you have a demand for 63.5 million ounces, but the vaults are effectively empty of unencumbered metal. How do the banks fulfill these delivery notices? They have to go into the open market and buy it. They have to become emergency buyers in a market that is already hitting all-time highs. Imagine being a bank that is betting against silver, losing money every second, and now, to settle your trade, you have to go out and buy physical silver at $77, $78, or $80 to hand it over to the person who beat you. This buying pressure acts as rocket fuel for the price. It is forced buying. It is price inelastic buying, meaning they have to buy it regardless of the cost. It gets darker. We are hearing rumors, supported by data anomalies, that the banks are beginning to cannibalize the ETFs, like SLV, to find the metal. They are looking at the massive stockpiles held by these funds and trying to use loopholes to drain that metal and move it to the Comex to satisfy delivery. They are robbing Peter to pay Paul, but Peter is watching. The ETF shareholders will eventually realize their metal is gone, leading to a legal minefield. The $17 billion from the Fed solves the cash problem for today, but it does not solve the 63 million ounce problem. You cannot print a silver coin. The only way to solve this imbalance is for the price to rise high enough that people stop asking for delivery. But at $77, the demand is actually increasing. This is a Gefan good scenario where higher prices actually drive higher demand because people realize the asset is running out. We must also look at the market signals indicating the capitulation of the smart money. There was another signal today, one that the mainstream media completely misinterpreted, either through incompetence or malice. We saw a headline cross the Bloomberg terminal. The borrow fee for SLV, the cost that hedge funds pay to borrow shares so they can short the price, dropped significantly. At the same time, millions of new shares of SLV suddenly became available for borrowing. The pundits on CNBC, the same people who have been telling you to sell silver for the last 3 years, immediately jumped on this. They said, look, the borrow fee is dropping. That means the squeeze is over. That means there's plenty of liquidity. They want you to believe that a lower cost to borrow means the market is returning to normal. They are lying to you. Let me explain what a drop in borrow fees actually means in this specific context. The borrow fee is a function of supply and demand. If everyone wants to short silver, the fee spikes. A high fee means the battle is raging. But what does it mean when the fee collapses to near zero in the middle of a historic rally? It means the shorts have left the building. It means that the demand for borrowing shares to bet against silver has evaporated. Why? Because nobody is stupid enough to short silver right now. The hedge funds have done the math. They see the $17 billion repo spike. They see the 63 million ounce delivery demand. They see the U.S. Navy protecting shipping lanes. And they have decided that shorting silver at $77 is a suicide mission. So they are returning the borrowed shares. They are closing their positions. They are covering. This isn't a sign of bearish strength. It is a sign of bullish victory. It is the white flag of surrender. The short army has disbanded. They have looked at the battlefield, seen the physical carnage, and they have retreated. Think about the psychological shift this represents. For 40 years, whenever silver spiked, the smart money would short it. It was a reflexive response. But today, with silver up $5, the borrow fee dropped. That tells you the reflex is broken. The smart money is terrified to step in front of this freight train. They know that the Fed is now involved, and fighting the market now means fighting the printing press of the United States and the strategic reserves of China. There is no profit in that trade, only bankruptcy. This effectively removes the ceiling of the market. As long as there were aggressive shorts, there was friction slowing the price down. Now that friction is gone. We are entering a vacuum squeeze, a market where the sellers simply disappear. This brings us to the most critical realization regarding the Fed S-trap and the return of inflationary bailouts. This brings us to the most critical realization, the one that affects the dollars in your wallet and your retirement savings. The Federal Reserve has stepped in to become the counterparty. They are effectively subsidizing the short position. The Fed had a binary choice this morning. Choice A, let the free market work. Let the banks who made bad bets fail. Let the price of silver find its true equilibrium, even if it sends the too big to fail institutions into bankruptcy. This would be painful, but it would be honest. It would restore true price discovery. Choice B, print the money, bail them out, destroy the credibility of the currency to save the structure of the banking system. They chose choice B. They always choose choice B. I want to pause here for a moment because this affects every single one of us. Do you think it is fair that your savings are being diluted to save these banks from their own gambling? Do you believe the Fed should have let the free market work, even if it meant a crash? I really want to know what you think. Please leave a comment below with your thoughts on this bailout. But there is a consequence to this choice. By printing $17 billion to suppress a crisis caused by inflation and currency debasement, they have guaranteed more inflation and more currency debasement. They are trying to put out a fire with gasoline. Think about it. The banks needed cash because the dollar is losing value against silver. The Fed's solution, printing more dollars, injects $17 billion new dollars into the system. What does that do? It devalues the dollar even further. It adds more fuel to the inflation fire. It validates the exact thesis that is driving silver higher. It is a self-defeating feedback loop. The more they bail out the shorts, the higher the price goes. The higher the price goes, the bigger the bailout needs to be. We are watching the beginning of a hyperinflationary meltup, localized specifically in the commodities market. The banking system has inadvertently trapped itself. They cannot let the price rise or they go bankrupt. But they cannot stop the price from rising without printing money, which makes the price rise faster. This $17 billion is just the first tranche. It is the tip of the iceberg. If silver goes to $80, which could happen before the market closes, that $17 billion won't be enough. They will need $20 billion, then $30 billion. We are going to see the repo market explode just like it did in September 2019, right before the global financial system seized up. This validates the concept of the Fed put. For 20 years, investors believed the Fed would print money to save the stock market. Now, the Fed has effectively placed a floor under the price of silver. If silver dips, the banks get in trouble and the Fed prints. If silver rips, the banks get in trouble and the Fed prints. All roads lead to the printing press. This removes the downside risk for silver investors. The worst case scenario isn't a crash, it's a bailout. And a bailout is bullish for hard assets. However, we must not look at this in isolation as we face severe geopolitical and systemic fallout. We must not look at this in isolation. The United States does not exist in a vacuum. Do you think Beijing didn't see that repo print? Do you think Moscow missed it? Our geopolitical rivals are watching the US banking system bleed. This validates their strategy. It encourages them to press their advantage. If you know your opponent is illiquid, if you know they are desperate for cash, do you ease up? No, you double down. You buy more physical metal. You squeeze them until they break. The $17 billion today didn't just save a few banks, it signaled weakness to the world. It told them that the US financial shield is cracked. China knows that if they can keep the price of silver above $80 for another week, they can force the Fed to print another $50 billion. They can force the US to hyperinflate its own currency just to keep the banks alive. It is financial warfare 101, and the Fed just walked right into the trap. Furthermore, the risk of contagion is immediate. The financial system is a daisy chain of leverage. JP Morgan is a counterparty to Citi. Citi is a counterparty to HSBC. If one domino falls, they all fall. The Fed knows that if a major bullion bank defaults on silver, they default to the clearinghouse. If they default to the clearinghouse seizes their collateral, their bonds, their stocks. This forces a fire sale in other markets. Suddenly, a silver crisis becomes a bond market crisis, which becomes a pension fund crisis. Silver is the small cog that turns the big wheel. If the small cog shatters, the machine stops. That is why they panicked. That is why they wired the money. They are terrified of a systemic failure event that starts not with bad mortgages, as in 2008, but with a short squeeze in the monetary metals. So, what does the road ahead look like, and why do we now have policy certainty for 100 plus of silver? First, we must accept that the $100 price target for silver is no longer a speculation based on industrial usage or mining deficits. It is a policy certainty. It is the mathematical output of the equation the Fed just wrote. If they have to print hundreds of billions to keep the repo market liquid, then silver at $100 is actually cheap. In a hyperinflationary liquidity cycle, $100 is the new $20. Next week, you need to prepare for extreme volatility. The beast is wounded, but it is not dead. The banks, armed with their fresh $17 billion of Fed liquidity, might try one last desperate smash. They might try to use that cash to short the market into oblivion on Monday morning to break the psychology of the retail investor. Do not let them. If you see the paper price drop $10 in a flash crash, do not panic. Smile. Realize that this is the death throes of a broken system. Realize that every time they smash the paper price, they are just making the physical metal cheaper for China, for India, and for the savvy investors who are draining the vaults. A paper smash in the face of a physical shortage is like putting a sale sign on an empty shelf. It doesn't create inventory, it just accelerates the panic. You must also watch the basis, the difference between the futures price on your screen and the physical price on the street. We are already seeing backwardation, where the spot price trades higher than the futures price. This is rare. It only happens during severe shortages. When you see dealers charging $10, $15, or $20 over spot, realize that that is the real price. The screen price is a lie. The street price is the truth. Follow the truth. We are approaching the unobtainium phase. We are very close to the moment where the major dealers simply run out of stock. The 12,077 delivery notices are sucking the wholesale market dry. Once the wholesalers are empty, the retail shelves go bare. The buy button will disappear. When that happens, the price effectively becomes infinity for anyone who isn't already holding. You won't be able to get in. The doors will close. If you are sitting on cash waiting for a dip, you are playing Russian roulette with a fully loaded gun. The risk isn't that you buy too high. The risk is that you can't buy at all. We must also prepare for the inevitable moment when the exchange declares force majeure, a legal term that essentially means they are changing the rules to save themselves. Friends, I want to have a serious conversation about what winning actually looks like in a rigged casino. It does not look like a polite check in the mail. It looks like a breakdown of the rules, and you need to be psychologically prepared for it. We are rapidly approaching a force majeure event. This is a legal clause buried in the fine print of every futures. Contract, a clause that allows the exchange to suspend trading and settle contracts in cash if unforeseen circumstances prevent delivery. Think about what that means for you. Imagine waking up on a Tuesday morning. The price of silver on the screen has hit $200. You feel vindicated. You feel like you have one. But then you try to buy metal, and there is none. Then you look at your paper contracts, and the exchange sends you a notification. Due to market irregularities, we are settling your contract at yesterday's closing price of $80. They will force a cash settlement. They will shove paper dollars back into your account and keep the metal. This is the force majeure trap. It is the ultimate rug pull. It creates a bifurcated market, a two-tier system where the official price is a managed illusion, and the street price is the harsh reality. We saw this with the London Metal Exchange nickel crisis, where trades were simply canceled to save a Chinese tycoon. We saw it in 1980 when the Hunt brothers were broken by rule changes overnight. History screams that when the banks are cornered, they flip the board. For those of you who have spent a lifetime building a nest egg, this is your wake-up call. If you're holding paper silver, ETFs, unallocated pool accounts, or futures contracts, you do not own silver. You own a claim on a bankrupt counterparty. When the force majeure hits, you will be left with fiat currency that is hyperinflating, while the physical metal moves into the vaults of the elite, the sovereign wealth funds, and the prepared few. This brings us to the most important point of all, legacy. Many of you listening today are not doing this to buy a sports car. You are doing this because you remember time when $1 bought a bag of groceries, not a single apple. You are doing this because you look at the debt mountain your grandchildren are inheriting, and you feel a moral obligation to protect them. You are the stewards of your family's future. When the dust settles, the only thing that will matter is what you hold in your hand. The digital illusions of wealth, the 401ks filled with overvalued tech stocks, the bonds yielding negative real returns, will be incinerated by the inflation required to bail out the system. But silver, the atomic element number 47, forged in supernovas, cannot be printed, hacked, or canceled. It is the only lifeboat that has survived every currency collapse for 5,000 years. So do not let the coming legal trickery shake you. When they declare force majeure, do not despair, celebrate. It is the confirmation that they have run out of real ammunition. It is the signal that the price discovery has moved from the criminal computers in New York to the honest streets of the real world. Ensure your position is physical, ensure it is secure, and understand that you are not just an investor. You are a guardian of truth in an age of financial lies. Finally, I want to leave you with a strategic action plan for wealth preservation. Friends, we are witnessing the greatest wealth transfer in history. But remember, wealth is never destroyed, it is merely transferred. It is transferring from those who hold paper promises, bonds, currencies, derivatives, to those who hold real things. For 40 years, the flow went one way, from the real to the financial. The financial economy cannibalized the real economy. Now, the tide has turned. The real economy is devouring the financial economy. The miners, the stackers, the holders of physical assets, you are the new captains of capital. The banks are insolvent. The Fed is trapped. The vaults are empty. The shorts have fled. The stars have aligned in a way that happens once in a century. Do not sell your position for fiat currency that is being printed to bail out your enemies. Hold the line. When silver hits $100, do not sell it for dollars. Leverage it. Borrow against it. Trade it for land. Trade it for a business. But do not trade it back into the burning building of the fiat system. The $17 billion signal this morning was the flare gun. It lit up the night sky and revealed the battlefield. And what we saw was a banking system in full retreat. They have abandoned the fortress of sound money. They are burning the furniture to stay warm. You have the metal, you have the position, you have the patience. The game is rigged, yes, but for the first time in history, it is rigged in your favor. The Fed has guaranteed your upside by guaranteeing the inflation needed to save the banks. The ghost week is ending. The reality is beginning. The wave is unstoppable and you are riding it. Before we conclude, if you are finding value in this unfiltered analysis and want to stay ahead of the coming financial shift, please take a moment to like this video and subscribe to the channel. Your support helps us break through the algorithm and get this truth out to more people who need to hear it. Stand firm, protect your legacy, and do not blink. The era of paper is over. The era of silver has begun.